and what you're paying for to get that. Property taxes, and it's paid to your local government or municipality, just depending. If you are charged property taxes and homeowners insurance. You might also pay private mortgage insurance, which is PMI. All of these costs are associated and included in a monthly mortgage payment. There are situations which people might use some of the same terms, principal and interest. When you're taking out a student loan, you might hear principal and interest. So when you're buying a car, you might hear principal and interest. Same thing when you're buying a home, you're gonna have to pay principal and interest. The principal is the original money borrow. If it needs to be paid back in full, the banker's gonna lend you $90,000 and you're gonna have to pay back $50,000, let's say, in interest. So you're completely paying $140,000 by the end, for example, by the end of your 30-year term. That's because banks earn a profit with the money that they lend. That's what they're charging you for the funds that you borrow. It seems like a lot over time, but again, it's broken down monthly with your principal payment. So the amount that you're paying for your home. And then your lender is going to determine the interest rate, which is a yearly percentage of the principal that you owe. The higher the interest rate, the more you're going to have to pay each month. So a down payment is the money that you use from your own funds towards the purchase of a home. So if you have $10,000 in a bank to buy a home and you buy a house that's worth $100,000, you're going to put $10,000 down as a down payment, and then you're going to get a $90,000 mortgage. Different loan programs require different minimums that you need to put. Regardless of the program you use, the down payment will generally be referred to as percentage of a home cost and not usually a dollar amount. So for example, your lender might tell you that you need to have a 20% down payment. In the case of the $100,000 home, that means you need to come up with $20,000 of your own money. And then you'll take out a mortgage for $80,000. If you buy a house that's worth $150,000, you're going to need a down payment of $30,000, for example. If you can't put down 20% of down as a down payment for the home, then usually you're going to require private mortgage insurance, which is PMI. So what PMI does is it protects the lender if you're unable to pay. Usually it costs anywhere from $30 to $70 per month for every $100,000 you borrow for private mortgage insurance. Depending on the type of mortgage you have, you could be able to eliminate PMI once you've had enough mortgage payments to have that 20% equity in your home. When a bank presents the interest rate to the borrower, it might offer the option of buying down the rate by paying a percentage of the loan amount back to the bank up front. This is called points. So the word point simply replaces the word percent. So your banker might tell you that the bank is offering 3%, but if you pay a quarter of a point, they can get you a rate of 2.75. So if you're borrowing $100,000, a quarter of a point is going to be $250. So you'll uncover several other costs when you buy a home. Some of these include an appraisal to ensure the value of the home is accurate, title insurance to guarantee that the seller actually owns the home and that there's no outstanding liens, an attorney fee, bank-related fees as well. When you apply for a mortgage, your bank will provide an estimate of all the costs, so you do know what to expect. And there are many aspects of getting a mortgage. Knowing what to prepare for and planning ahead will make the process much smoother when you're ready to buy a home. Even if you're only thinking of buying a house, it's not too early to begin to prepare for a mortgage. The more time you have to get yourself ready, the better off you're going to be. So let's discuss budgeting. Knowing how much you earn, spend, and save can help you figure out how much of a mortgage and down payment you can afford. Adjusting your spending and saving habits now, even if you're a few years away from obtaining a home, you can put yourself in a better position to improve your credit score and get a better mortgage with favorable terms. Creating a budget helps you get a clear picture of your finances. Whether you want to buy a house, you want to go on a trip, or you're saving for any other goal, a budget is an important early step. As I mentioned before, you're going to need to prepare to pay a lump sum for down payment. So let's see if there's any areas in your personal budget that will allow this. So when you think of your down payment, think of, do you have more monthly debt payments than income? Did you notice any areas that you can cut back? Are you saving for a down payment? So as you think of getting your mortgage and you're creating your budget, if you're having extra income, that can help towards your budget for buying a home. If you're not saving for a down payment, think of some ways that you can cut back to start putting money away to save for a home. And again, that entails budgeting. So how can you use budgeting to improve your ability to get a mortgage? Let's find out. Preparing for a mortgage involves budgeting, research, and getting pre-approved. Let's take a closer look at these and other steps. As we go through the steps, just take a look and think if you're ready, if where you need to be. In your participant guide, which you'll get afterwards, you're going to be able to check off the steps that you already have taken, or be able to plan for the steps that you need to take in the future to be able to buy your home. So we talked about budgeting, right? Making your own budget. You're going to do this by cutting down on expenses, paying off debts, and understand what monthly housing costs you can afford. When you're thinking about budgeting and saving for money, consider paying off as much as your debt as you can before you apply for a mortgage loan. This is a good way for you to help build and improve your credit, and it's going to help your chances of getting, again, a favorable mortgage. You also need to get your credit score, right? A good score can also mean a lower interest rate. When it comes to buying a home, the rate makes a huge difference by getting a lower rate. Even that 0.25% off, if you multiply it over 30 years, it's thousands of dollars that you're paying, either extra or saving, just depending on your interest rate. So just being prepared and having a good credit score is really going to make a difference in the amount that you're paying in interest. You're able to get your score from a company that uses a numerical scoring model. So you can pay for a score from FICO by going to www.myfico.com, or you can get a free score from Vantage Score. Although Vantage Score is going to give you a score that's close to your FICO score, mortgage lenders usually use the FICO score. Mortgage lenders usually take the middle score of the three from TransUnion, Equifax, and Experian. So those are the three credit bureaus that we use in the United States to help identify credit and credit scoring. So what happens if you have a poor credit score? You don't have to worry. You can improve it by just following the most important rule of credit: paying your bills in full on time. If you think you're going to be late on the bill, call the lender and try to work it out and make a payment plan. And after 30 days, credit will count against you. So it's always the best practice. If you're unable to pay your bills, just reach out to the lender, see what they have, what they can offer you. Now with the pandemic, there's so many other opportunities that different financial organizations, institutions, and lenders have to be able to help assist everyone. And then improve your score if necessary. You want to make sure you have and collect documents. Keep at least 2 years worth of the following records in case a lender wants to see them. So usually they will ask for 2 years of your tax returns, your W-2s. They'll ask you for your employment history, and they may need to see bank statements. And then let's get back to the steps of preparing for a mortgage. Calculate home affordability. So as you look through your budgets and you see how much money you have left over every month after paying your debt, you're able to use, by going to mortgagecalculator.org, you can use a calculator to see how much of a payment you can afford on a monthly basis, and then be able to determine how much you're going to be able to borrow. So you also have to consider, when you're looking at the calculator, that you still need to pay for real estate taxes and homeowners insurance. That does take an effect when you're looking to buy a home. Depending on the cost of the home, the taxes of that home, it can affect your ability to get that home or not. So just keep that in mind when you're looking for a home, that taxes and homeowners insurance can make a difference. And then start saving for a down payment. So once you know how much you can afford, you can save for it. Paying down your debts, pay off your debts can give you a good start to improving your credit score, which again can help you qualify for a better rate. Doing this can also put you in a better position to take on new debt in the form of a mortgage. And then you want to also make sure that you're researching mortgage companies. Different lenders have different terms, different programs. They have different fees and requirements. So just shop around and see. And when we mean shop around, get the information. Don't necessarily apply for multiple loans. Just inquire about the fees, requirements, what type of programs that they have. And then you want to compare the interest rates and the loan amounts. And you want to make sure that you're picking a lender that you trust, one who offers good customer service and is available to answer all your questions. And then lastly, you want to get pre-qualified or pre-approved. Some lenders only offer a pre-qualification, while others can give you a pre-approval. Work with your lender to see what is required from you. In general, to be prepared to give the lender this information when you're applying for either. They're going to want to see proof of your annual income, proof of your assets. If you have investments, property, or car, for example, they want to see a record of your debts, like loans or credit card debt. And then they're going to want to look at your credit history. So usually they're going to pull, with your permission, your credit report, and then get a record of your debts that way, and then view your credit history. So what does pre-qualification or pre-approval mean? In return for providing a lender with information, so giving them your income, assets, and debts, the lender's going to give you a letter stating the mortgage amount and the interest rate that they're going to be willing to offer you. It's not an approval, nor are you obligated to actually take your loan with that lender. It's just an estimate. This process lets you find out about any problems that you might have when it comes to getting a mortgage, so that way you can work to address them. When you're making a budget and knowing how much you can afford, they're important steps, right? But you also need to know the type of mortgage that you're going to want, or the type of mortgage that's going to be better for you. Choosing the right mortgage depends, again, on your income, your credit, and your down payment. It also depends on how quickly you plan to pay off your home and how long you plan to live in your home. When you make a payment on a mortgage, it's going to affect your loan in different ways. With most mortgages, in the beginning, a larger portion of your payment's going to go towards your interest versus the principal. As you pay down your mortgage over time, a larger portion of your monthly payments are going to go towards principal until the loan is paid off. This is what's called amortization. Sometimes mortgages are structured so your payments will go only towards the interest for a specific period of time before being applied to both the principal and interest later on. Some mortgages have a fixed interest rate for the life of the loan, while others have adjustable rates. So if you get a fixed mortgage rate, your monthly principal and interest payments will remain the same for the life of the loan. That doesn't mean that your total monthly payment won't change. So remember, you're still paying taxes and insurance, and that can go up as well or down over time, which can make your payment change. So for mortgage purposes, the word term refers to the number of years you're borrowing the money. So if your mortgage, if you look on the slide, has a 15-year mortgage, it just means that you're paying the loan for the next 15 years. So in general, the shorter the term of a fixed rate mortgage, the higher your monthly payment's going to be because you're repaying the loan quicker. However, shorter term loans often have lower rates because they're less risky for lenders. Because of this, you're going to pay interest over the life of a shorter loan, and it's going to be less. When you take out a mortgage for 30 years, you're going to pay more in interest, but your monthly payments are going to be less. So again, if you look at the slide, one example for $100,000 home, your rate's lower, your monthly payments are higher, but then again, you're saving more than $50,000 over the remainder of the 15 years for the same mortgage. If you have an adjustable rate mortgage or ARM, the interest rate is going to be fixed for short term, and then it's going to range once that term expires from a month to several years. After the initial term ends, the rate, again, it's automatically adjusted monthly, quarterly, or even less than that, just depending how your loan is structured. Because of this, your monthly mortgage payment can vary over time. It can increase or it can decrease. One risk of ARMs is that the interest rate may suddenly increase so much that you're not able to afford your mortgage payment. If you get a biweekly payment mortgage, your rate's going to be a fixed rate like regular mortgages, but your payments are going to be every 2 weeks. Because there are 52 weeks in a year, this works out to 26 payments, or one additional monthly payment per year than if you were to make 12 monthly payments. This method can also help you pay down your loan quicker. Keep in mind, if your lender offers a biweekly payment,
This is Cassandra. There you go. I was about to ask you about, did you change the slide? I'm sorry.
No, it was still the same. It's still the same slide, but I'll move it so you guys can. So if your lender offers a a biweekly program, they may work with a third party that's going to charge you fees to make biweekly payments. You can still do that on your own. That's something that we do. We make extra payments on our own just to help pay down our loan faster. So instead of making your biweekly payments, you can always add an extra payment at the end, or, set up monthly payments and then every 2 weeks make the payment. You're still going to save over time doing that way, and then you avoid paying any third-party fees. Knowing the types of mortgages and how they affect your monthly payment is a good step towards securing a mortgage. So another step is finding out the right source. So let's look at different lenders. Slide, there's many different types of mortgage lenders. There's banks, there's credit unions, there's savings and loan associations, you have mortgage bankers, and you have mortgage brokers. So these are all the different places that you can go to get a mortgage. So mortgage, when it comes to mortgages, banks and credit unions, they usually work with a mortgage loan originator. So these are people that are going to specifically work for a bank, and they're going to help you with your requirements and your qualifications. When it comes to savings and loan associations, sometimes this is called thrifts. These financial institutions provide many of the same services like bank, but tend to place a stronger emphasis on residential lending. So they're banks, but they offer just more or less residential lending, versus with the bank, you can do commercial lending, things like that. Then you're also able to go to a mortgage banker or a mortgage broker. A mortgage banker works for a bank or another financial institution that lends you the money for your mortgage. After originating the mortgage, the lender continues to service it, or they can sell the loan to another organization. A mortgage broker, they're an agent who brings together lenders and borrowers. Brokers don't actually make loans. They actually find a suitable lender for you, the borrower. The selected lender provides the mortgage and then pays a fee to the broker for the services. A mortgage broker works with different banks and financial institutions, but they do charge a fee or they take a percentage of the loan as a commission. Financial institutions typically give out loans to individuals with good credit scores and may have some restrictions on interest rates. If you have a poor credit score or if you qualify as a veteran, there's other options available to you. You can go with mortgage bankers or mortgage brokers. They might be able to give you other offers or better offers. In addition to private lenders, the federal, state, and local governments can also lend you money for mortgages. The FHA, or Federal Housing Administration, is a part of the U.S. Department of Housing and Urban Development. They approve lenders and loan products. HUD's main goal is to make sure that affordable housing options, that they exist for anyone who wants to rent or they want to buy a home. To achieve that goal, HUD runs loan programs to the FHA to help people who may not qualify for a mortgage get one. So consult with the HUD approved housing counselor for more information. You can just find one if you go online at hudgov.org. Most states have also finance agencies to provide affordable loans and housing options to their residents. If you belong to a special group like veterans or first-time home buyers, or if your income is below a stated amount or within a particular range, you can qualify for a special program. So just contact your state and local agencies to see and learn more about those programs. You can also reach out to different financial institutions, banks, credit unions to see if they have special programs that they offer. So as we're talking about these programs, when it comes to FHA, apart from lenders, federal programs, products, and resources that are available to help home buyers navigate, secure, and manage a mortgage, you can even get help with your down payment if you qualify. Again, they have their own requirement and terms. We're going to take a look at them, but think about whether you're going to qualify or not, or if these programs could be helpful for you. For FHA loans, or the Federal Housing Administration insured loans, they can help insure your loans so that you're able to get a better deal through a private lender, like a bank, credit union, or a mortgage company. If you don't have a long enough credit history or a huge down payment, this is a good way for you to go through because you're still able to possibly qualify for an FHA loan. So Federal National Mortgage Association, or Fannie Mae and Freddie Mac, these are two of the terms that we've heard about. These also offer many different loan programs. A lot of these programs are for first-time home buyers. A lot of these programs are for low to moderate income buyers. Again, depending on the profession that you have, you can also take advantage of those types of programs. And then there's VA insured loans for you veterans, for any eligible veteran service member and surviving spouse. The VA is going to guarantee a portion of a loan from a private lender. The type of program that you're going to qualify for can depend on the length and status of your service. And then you're going to need a certificate of eligibility, which you're able to obtain online, mail, or even through a lender. And then there's the USDA. For those of you who are looking to buy a home in rural areas, the USDA offers several types of loan assistance, both direct loans and guaranteed loan programs. Loans such as Section 502 Direct Loan Program assist those who may have a difficult time qualifying for traditional loans. For a direct loan from this program, your income's going to need to be less than a specified amount, which varies again depending on where you live and how many people live with you. And then you need to have that property be your primary residence. And then you also have to be a citizen or an eligible non-citizen. And then there's also down payment assistance programs. These are different loans and grants that you can obtain. If it's a grant, this is free money. So always look for the free money before you go getting your loan. See what's out there. Again, do your research, reach out to different banks, see what they have to offer, what types of grants and loans that they offer where they can help assist you. So whether you're ready to get a mortgage or think about getting one, you can take some steps to prepare to be able to meet with the lender and find a mortgage that's going to be best for you. So you want to make sure that you find out your credit score. So you can either go to the annualcreditreport.com to get your free credit report, or go to myfico.com or VantageScore to get your credit score. So good credit score is usually anything 670 and above, but that's not what's needed to get a home. If your score is under 670, just continue to make sure you're paying your bills on time, that you're just, reviewing your credit report, disputing any errors that you have, and then still talk to a lender. Those special programs that we just talked about, they usually will help you if you have a credit score under 670. Again, saving for a down payment is something that you're going to need when you're buying a home. The general rule is to try to save up to 20% of the purchase price. Just remember, the more you're able to give as a down payment, the better your rate could be, and then just the less you're going to end up paying over time for your mortgage. You want to make sure that you compare again cost, see what the fees are for the different mortgage lenders you're going with, insurance, interest rates, what are the down payment requirements for that lender. And then you want to make sure that you find a lender that you can trust. Watch out for brokers or lenders who might want to offer you loans with interest rate that are going to increase more than you're comfortable over time. So if you do choose an adjustable rate mortgage, you need to make sure you fully understand how it works and understand that your interest rate will change. So how do you prepare yourself for a mortgage? But how you go about applying, right? We talked about how to prepare. Now we're going to talk about how you go about looking and applying for a mortgage. Again, we talked about pre-qualification or pre-approval. This is just to help lenders identify whether or not you're going to be able to qualify for a loan. A pre-qualification is just an estimate. When you get a pre-approval, you're still going to have to get approved afterwards. Or excuse me, pre-qualification. When you get a pre-approval, they're actually reviewing your income. They're actually reviewing your credit score. And they're saying you're going to be pre-approved for this amount. So then just depending on the home that you choose, it's going to determine again if you're going to finish proceeding for the loan. But a pre-qualification is just giving you an estimate, where a pre-approval is actually viewing your income and it's looking at your credit and it's giving more accurate information. A lot of the times now when you're looking for a home or you're wanting to work with a realtor, they're going to actually want a pre-approval letter, not just a pre-qualification letter. So they want to know that you're serious, and they want to know that a lender is going to be able to approve you for a loan. So loan estimates, this is just a process where the lender's going to review the sale price of the home, and then fees, and they're going to prepare for you a loan offer. It's not your final estimate. It's just the loan estimate, just based on the information that you gave. That's what they're stating your payments and all your fees are going to be. And then you want to make sure that you evaluate your loan offers. So it's just where you're comparing loan options from different lenders before you're deciding which to choose. And then you're going to get a settlement, which is a process in where you choose a loan and sign paperwork to receive it. So that's at the very end. You're going to get your settlement offer once everything's finalized. They did the appraisal. You're ready to close. You're going to get one final statement, one final paperwork that's going to tell you exactly what your mortgage payment's going to be, what the fees are associated with it. And that's the paperwork that you're going to sign at the end for your home. And then this is just, again, when you're taking a look and you're comparing mortgage offers, just compare the two. For this example, one interest rate's at 4%, the other one's at 5.4. One has, the 4% has less fees, but they're requiring 20% down. You're borrowing $80,000. You're taking the term for 30 years. So total amount you're paying is $157,696. The loan too, you're at a higher rate, but you're putting less down of a down payment. You're borrowing more, finishing off in 15 years. And then you're paying about $13,000, a little less than $13,000 less than option one if you were to go with the 15-year. So those are just different examples. Again, your situation is going to vary. The bank you choose or the lender you choose, their fees. This is just an example on what it looks like. So now we've come to the end and we've talked about the common types of mortgages and how you're able to obtain them, what the costs are associated with mortgages, and then how to explore special financing products and resources that can help you assist when buying a home. The biggest things to remember is budgeting. Budgeting is really important when you're ready to buy a home. Even after you bought your mortgage, it's important. Now you have this larger payment that you didn't have before. You want to make sure you're budgeting for that. You want to make sure, again, for credit, you're paying your bills on time. That's the biggest thing that affects your credit, is not making your payments on time. And then you want to make sure that you're researching different programs, different lenders. That's going to help give you the best, not only best rate, but just best option for you and what you're looking for when it comes to buying a home. It is the biggest purchase that you will ever have to make. You want to make sure that you're going to, and you're getting everything explained correctly and that you're going to the right person. That way you avoid any mistakes that can happen. Any questions?
Yes, I have. I'm looking through Facebook and no one there has a question yet, but I did receive a message from someone, and actually they had two questions.
Mhm.
One of her questions, she wanted to know, when you have an escrow shortage and you pay the shortage, why does your mortgage still increase?
So your escrow shortage, so we pay our mortgages in the rear. So when they're giving you a shortage, they're actually, you're paying what you owed in the past, and now your mortgage, your taxes are more. So that following year, you're going to have to pay more because your taxes went up. So you're paying what you're paying in the rear. If you're paying it up front, you're just paying what you owed, because when you escrow, the lenders are paying the payment on a monthly basis, right? Your taxes will come out certain time during the year. You're going to know actually what the cost actually is, what they're actually charging you. The lender already did your estimation for the prior year, so that's why you have a shortage. the following year, your taxes already went up. So you're going to have to pay that new rate. Usually, if you pay your shortage up front, you're paying less for the following year than if you didn't pay your shortage. So let's say it's, for the sake of math, $10 a month that you have to pay extra going forward. But your shortage was another $10. So your payment's going to be $20 to pay what you owed in the past and now what you're owing going forward. Either way, it's going to go up. You're either paying last year's and this year's the following year, or you're paying last year and then just paying the new payment the following year.
Gotcha. Okay.
It's confusing, but we pay our taxes in the rear, so that's why.
The bottom line, because we're paying our taxes in the rear. That's why.
Yep.
Okay. And then secondly, the next question was, if I paid my house, there was someone who paid their home off, and they later wanted to take money out. And this didn't make sense to me, but I'm going to say it to you the way that they told me. They paid the house off, and then they wanted to borrow $10,000. Were told no, they couldn't borrow.
Did they take out a home equity or what? So when you pay off your home, you have the value of the home, it's all yours. So you have equity in the home. You have different options. You can take out another mortgage and pay all the fees associated with doing another mortgage. Or a lot of people would do a home equity. So they're just borrowing on the equity. Usually when you take a home equity, your interest only payments, you have to pay additional if you want the principal to go down. It's a shorter term, less fees associated with it. If you try to get a loan and it could be maybe you weren't approved because of credit or income qualifications, even though your home is paid off in full, you still need to qualify for the new loan that you're trying to get.
Okay.
So credit is going to play a factor, income is going to play a factor too.
Okay. All right. Well, that is all that I have. No one here on Facebook has any questions. I think they're just listening. Everyone is listening. So yeah, so this is being recorded. It will be uploaded to YouTube for later viewing for anyone that would like to see it. If anyone have any questions, Ms. Torres, can you leave a number?
Yeah.
Okay. What is your number?
630-520. Oh, that's my stuff. 630-200-3126. And then I will, in the chat, also leave my email.
Can you say the email out loud for those that are on Facebook?
It's yahida.ramos@bmo.com.
All right.
And like BMO, for example, right now we have where you can get up to $29,500 if you live in Illinois as down payment assistance for a mortgage. Again, there's different terms, different qualifications needed to obtain that, but that's just special programs right now that we have with when it comes to free money. Always look for free money. I like that term, free money. Yeah, always look for free money first. If you don't qualify for the free money, at least you tried, right?
That's right. That's right. Okay, so what I'm going to do, I'm going to end my Facebook and stop the recording. Let me stop the recording first, but I would like to say thank you to everyone that came on, asked questions, had questions, or just wanted to view. Sending you a big old heart, as well as letting you know to tune in every second Tuesday of the month from 4 to 5, where you will be able to see and hear Ms. Yahida Torres talk about anything banking. And if you're not doing anything this Saturday, come on out to the Holiday Inn in Countryside, where we will be honoring 25 women veterans that shared their story as to why they decided to join the military. The event is called Why I Serve. It is on, tickets are being sold on Eventbrite, and you will also be able to send your requests to Top Flight Defense Inc. at gmail.com. Okay, let me end that.